Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. Today I'm going to discuss more of the 20 pip challenge program that we wrote a couple of weeks ago. I haven't done an update of it simply because it requires time to collect the information since it is using real and live market data. Well, today I'm going to go over a preliminary analysis of how well it has done. So far, it has taken only 46 trades, which is to be expected because the moving averages are very specific in the entry points and when and where it purchases. So what we are looking at on the screen is those trades thus far and the results of those trades. Let's get straight into the raw numbers. We can see the budget here, $100.29. And the first trade was in fact a profit. Now for this particular demo account, I'm using very small numbers. Only 1% of the account, so proper risk management. This is absolutely critical when using this type of a strategy. Your first and most important aspect of trading is proper risk management. Anytime you're dealing with a stop-loss based algorithm, you must make that a priority. So we see the very first purchase and transaction was in fact a profit. Then you see the next one after that was a loss, and then a profit, and you see where the market direction is changing consistently based upon the 200 period moving average. So if trades are above the 200 period moving average, it opens a long position. If trades are below the 200 period moving average, it opens a short position. And when I say trades, I specifically mean that the crossover is going in the direction of the market and that the closing price is below the 200 period trend line. So we want the strategy to try to follow as much as possible the direction of the market. And we can see here that we won 2 out of 3 trades in the long direction as the price was above the 200 period moving average. Now there is of course no guarantee that price will respect the trend, but you can see overall with this kind of a strategy that more often than not you get a very resilient consistency that does help. But there are cases like this one, a loss and a loss, where the market simply has no respect for the trend. So trend is kind of a double-edged sword. Sometimes it's your friend and sometimes it's your worst enemy. You never know until you try it. And out of 46 trades, we have a very good indicator as to how well this strategy works. And it works quite well. It is very successful. Whether or not it is long-term profitable is an entirely different question. Remember, success never equals profit. The standpoint of the algorithm is a success because it is doing exactly as it was programmed to do. Now that cannot be said in all cases. Sometimes algorithms aren't successful because they enter inappropriately because the parameters aren't defined clearly enough. So you need to really make that kind of a distinction when you are using algorithmic trading, because you can have a failed strategy that may be profitable, but it is still failed because it did not adhere to the strict entry and exit points it was supposed to. Algorithmic trading is a scientific and mathematical process. With that being said, let's continue and look at the balances along the way as we see how well it has done in the long term. And there are a lot of cases where you will see it does take losses and you do see profits drop. That is normal for this kind of strategy. It is a realistic situation. This strategy works nicely. 20 pip profit, 15 pip stop loss. Now, if you wanted to apply it to the cryptocurrency market, it would be a 2% take profit with a 1.5% stop loss. It translates very nicely and very well in either market and will work pretty much the same based upon the volatility of the assets you are trading. So let's get straight to the bottom, the final value. And you see that we are under where we started. Not by much, but nonetheless, we are still under where we started. This type of a strategy, its best case scenario in a worst case condition, is that it won't lose that much of the original balance. It will always stay pretty close to neutral as a worst case situation, which is really the best case in terms of just how bad the market can really be. So we started out with $100 and change, and right now we ended with $99 and change. Not that far from where we started, which is good. Again, showing just how successful the approach is in relation to just how bad the markets can be. So in a worst case scenario, where the market may or may not be in the ideal condition, you have a reasonable assurance that your balance is protected very well against markets that simply trend against you for a prolonged period of time. Because when the markets do go in your favor, you will make up the difference quite quickly, and you are likely to be able to eliminate a lot of false signals because of the kind of entry point that this particular strategy uses. But, yes, there is a but. We can do better. We can always do better. Whether or not that translates to profit is a different story. But there is a way to do better. Using a stop loss is always a double-edged sword because it does in fact cause losses. That is the whole point of it. Many people believe that it will mitigate your losses, and that may or may not be true. It is important to remember that a stop loss order is nothing more than a triggered market order. And just like any market order, it can get out of hand very quickly and go in a very bad situation. So the second approach that uses the 20 pip challenge is an accumulation approach. And it has its own risks, just like the stop loss does. This is the same asset, Euro Canadian dollar, using the same 20 pip challenge with a slight variation. Instead of a stop loss, I am making a second or third or fourth purchase. That is, I am using accumulation. And that accumulation is opportunistic dollar cost averaging. As you can see, as prices drop below the red line and all of the indicators are matched, it will make a purchase. But as soon as prices go above the green line, 20 pips, I make an opportunistic sell. So let's go back and look at where a purchase would take place in terms of the accumulation stage of the process. Okay, we see here the stair-step patterns indicated by the buys. So 3 purchases right here took place, and those 3 purchases produced 1 sell point. So at 15 pip intervals, it made a purchase, and it kept doing that until it drove the price down by the average, so that as soon as the average was low enough and the price crossed above the take profit zone, it made a profitable purchase. Now the risk is that you could always end up with a long bullish run if you're trading short, or a long bearish run if you're trading bullish, and the market can go against you in a very bad way. It's a give and take process where you need to think about the approach. So here, in terms of the 3 moving averages I am using, the very same technique as the stop loss version where I demonstrated the learning Python approach. This is the same technique using accumulation and not a stop loss. It works well, it works consistently, and it works simplistically. That really is the whole point and reasoning behind accumulation versus stop loss. Both mitigate risks in different ways, and picking the one for you is what will define your trading style, your edge. I personally prefer accumulation over stop loss. I would rather wait time for an asset to go in my direction than take a hard loss on my account. It is simply a matter of my preferences. But you can see here that I had a total of 12 completed trade cycles for my accumulation, and my worst case scenario was 14 positions. Or if you're trading in terms of US dollars, this would be roughly $14 to $16. If you did units of 10 each position, it's 140 units. If you multiply your units out by your margin, then it would be more than that. Overall, though, my average was only 3 purchases, which is acceptable in terms of what I was looking for my trades. So you have a good, clear indicator of your average, your worst case scenario. Use the golden rule, round the number up to the nearest 10, and double it. So if I take this number, round it up 20 positions, double it 40 positions is my worst case scenario. So if I calculate my budget based upon that, I have a reasonably safe way to protect my margin. The duration of this was roughly 19 days, 12 completed trade cycles, and roughly 20 pips per every single completed trade cycle. Remember that a trade cycle is the beginning of the purchase to the actual selling point. And this can be converted to a reasonable cryptocurrency system simply by going from 0.2% for a take profit to just a flat 2% for a take profit, meaning you're moving from 20 pips to 2%, which is roughly equivalent between both markets. The same with your deviations. 0.15% or 15 pips becomes 1.5% in the cryptocurrency market. Keeping your numbers simple and easy to work with along the way of being able to make sure your strategy is well tuned. That is the important and critical part of the process. Take time to make sure your strategy is well tuned. Test, analyze, evaluate, and run forward analysis on your strategy. You must be careful with protecting your margin, whether it's cryptocurrency or Forex. Don't over leverage your positions. Always allow for more than you will ever use. In my own personal trading, I always keep my margin less than 20%. I also factor my worst case position on a price that has never occurred within the market. Again, risk management is absolutely critical. Do not underestimate just how powerful that skill is. Any bad market with proper risk management can become a very profitable market. So whether you prefer a stop loss or an accumulation technique, a 20 pip challenge type system like this one is a wonderful way to profit in any market and under any circumstance. Like the video, help me with the YouTube algorithm, leave some comments. What do you think about the 20 pip challenge? Do you like a stop loss or do you like accumulation? Let me know. Thank you for watching, and until next time.